Welcome back to the first trade. Stocks off their lows of the morning, now down about 152 points after being off more than 200 earlier. In this volatile stock market, there is increased speculation that some asset classes, they're starting to look a little bubbly. Take the NASDAQ 100, for instance. It is up more than 40% from its March lows to near an all-time high, and that is despite a global pandemic and double-digit unemployment. Joining us now to discuss is Harvard lecturer and author of Think for Yourself, Vikram Mansharamani. Vikram, great to have you here. Thanks for being with us. You say there is, and we've all been talking about this disconnect between the market and what's going on Main Street. You say a lot of that is being fueled by the passive investing boom. What do you mean by that?
Yeah, I think, there's been a religion among investors that passive investing is better than active investing because it's lower cost and you don't underperform the market. You get the market returns. Well, the problem is, as passive investing has grown as a percentage of overall investing, what we've seen is the logic of being a price taker. Prices are accurate, let me just accept them with lowest cost, has turned into a logic of price making rather than taking. And now it's flows that drive prices almost as much as fundamentals. And I think that's what we're seeing here, is that the fundamentals are mediocre, the valuations are rich, but the flows are strong. And that's what's driving the market to some extent.
Vikram, what's the trigger point that causes this bubble to explode in passive investing?
Yeah, look, that's a tough one. That's a really tough one, Brian, because fundamentally we've gotten ourselves in a virtuous cycle where higher prices are driving more people into the market. You've got this fear of missing out. You've got a momentum logic even embedded in this passive investing dynamic, right? Because some of these market cap weighted indices result in the highest cap weighted names that are doing really well, resulting in the need for more buying of those in the index tomorrow. And you throw into that mix a little bit of closet indexing. So to answer your question, it's got to be a turn in the flow of the inflow has to turn into an outflow, and then this virtuous can turn vicious. And that's something to really watch for. So far, there haven't been many signs that it's ending.
Vikram, I know one of the signs you look at to see if a bubble is about to burst is you look at the global mining index. I found this to be very interesting, and its relationship to stocks, specifically the NASDAQ 100. You saw it in the previous tech bubble bursting, I guess, in the early 2000s. What are you seeing now?
Yeah, so look, there's this wonderful chart. I look at the global mining index divided by the NASDAQ 100. And if you look back at that chart from really the late 80s to the present, it operates almost like a sine wave, and it turns usually at recessions. So at the top in the late 1980s, it was a fabulous time, really starting 1990, to be invested in tech and out of materials, let's just say. And you can also call it not just a tech versus materials, you can call that a growth versus value. There's a lot of different things this one particular chart would show you. But really in the 1990s, you wanted to be long tech and not in materials. And then you hit right at the internet bubble peak around 2000, a bottom in that ratio. Then it turns around and you really wanted to be long materials and not involved with tech for really right up until the global financial crisis, at which point the chart turns around again. And then you really wanted to be long tech or growth and not in the way of materials right up till today. Today, that ratio is roughly the same as the internet bubble peak.
Vikram, you also advise CEOs on how to navigate uncertainty, and this is certainly an uncertain environment. What's the biggest fear these CEOs have on their minds right now?
I still think there's a lot of supply chain disruption risk that people fear, right? The trade war created this dynamic of, I'm not sure what the price of my key inputs from a faraway supply chain may be. Then the pandemic said, I'm not even sure I'll get the key ingredients I need from my supply chain. The supply chain logic of just in time, lowest cost, most efficient has been shifting towards just in case resilience. And I think that anxiety, combined with the consumer weakness and obviously an economic recession right now, is causing boardrooms to be a little nervous. That's making them hold back on some capital investing and some strategic decision making. I think people are really retrenching and sort of a little nervous in the boardroom.
All right, Vikram, Mansharamani, thank you so much for being with us, the author of Think for Yourself.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.